that it does make sense. And as much as I completely agree with what you're saying, you know, I would have still loved to see that there is the potential and there is the capabilities for younger students that are graduating to really have the ambition of going off and opening up their own businesses. I mean, there's so many great ideas out there that without financing, they're really being killed. It just takes us back to the 50s and the 60s where there were a lot of great ideas, and again, the environment itself wasn't at all even close to what we have today, but it was killing a lot of ideas and was killing a lot of ambitions. And you should see that the amount of ambition that exists in this country, and we need to also understand that 50% of our population is under the age of 33. So, I mean, either you're going to be able to employ all of these people, or you're going to have to be able to provide them with some kind of starting finance to be able to open up their own businesses, move outside the 6% of our land area that we live in. We've got 94% of our land that is not being used. That's renewable energy, that's agricultural projects, that new cities that could be built. I mean, there is so much. But again, I guess it's still a very immature market. And it brings me to something that is quite interesting, and that is credit. And that is credit rating, to have, you know, credit worthiness. And I'll give you a very small example, because Mohamed Rifat, who runs iScore, it's a great concept, and I think it was needed. I don't know how effective it has been, with all due respect, not because of how it's being managed, but because of the environment that it's in. As a business owner, I applied for a credit card. I didn't receive it because I'm a business owner, but my employees receive credit cards because they work for me. You know, how is this whole concept of iScore, how is that going to help a small, medium enterprise actually walk in, be able to access finance? And I'm not just, again, talking about loans. It could be a line of credit that can help out when instead of check bouncing, which would impact, you know, our credit rating, but, you know, just that little bit of mileage that can help. Buying back contracts, for example. We have, you know, 1 year, 2 year contracts that we can go back to the bank and say, listen, I mean, we've got credible clients. Why can't we be helped out here? So on that credit front, how are you going to be able to build the capacity and the volume, number one, to make your business profitable, as we were having a discussion earlier? And is it the chicken before the egg? I mean, do I start getting credit rating before I start borrowing money, or do I borrow money first, then you can say whether I have good credit or not? But how do you assess that?